These past few weeks have been absolutely insane in the markets, and Jerome Powell did nothing but really spurn the party forward, even if he didn't intend to. So what exactly did he say that made the markets move up, and what does that mean about what to watch for going forward from here? I got that for you. I'm Dr. Stock, Doctor of Education. Let's get right into it. All right, so just a quick technical analysis that we have here on the SPY. And if I zoom out a lot, because I do like to zoom out to see where we sit, off of today, when we go off of about the high, you can see we run into, actually, matter of fact, let me help you out to see it. I'll put on some drawings here, horizontal line right across these bottoms. So this bottom over here, that top over there, line up pretty well for us. We do have some room should we be able to break through that resistance. This peak over here is our next stop all the way up at, let me zoom in a little bit so we can see it. There we go, the high price, 428. So that would be another $12 up from here. So that means another 3% to run before we run into the next area of resistance. And after all this up, it's hard to believe that we don't see a little bit of down coming in. And if we believe that we're into a next bull run rather than just a bear market rally where we get a little bit of bullish behavior, we have broken up above previous highs, our most recent previous highs, well above those. We've broken trend, we're above trend. And if I go back to the indicators and put on the moving averages, you can see not only are we above the 250 day, but we also have the golden cross that I mentioned a few days ago in my video that it looked like we were nearing it. Now we have it. That's a very bullish sign for us. And so before I get ahead of myself too much, we got that. So let me take the moving averages off and let me get rid of this horizontal line that we have here. Like I said, maybe we squeak out another 3% over the next few days before resting a little bit. You know, let the bulls who've been running a lot recently just rest for a little bit before we continue. Maybe create some buying opportunities. Maybe be able to shuffle around our portfolios a little bit. I want to put on here the Bollinger Bands because when we look at the Bollinger Bands, what the middle line shows us is the moving average that we have for that. So the line above and the line below that seem to wiggle like a piece of bacon with it, they are showing us 2 standard deviations away from the mean. And when we look 2 standard deviations away from the mean, anything outside of that is, well, on the high side, atypically high, so not unusually high, and anything outside of that to the low side is unusually low. And with the law of large numbers, we normally tend towards the mean. So with that said, here on this candle where we broke down below the low point of it, you can see we had a strong rally where we closed back towards the mean, and over here we broke above it. It wasn't long after that we weren't able to sustain those prices. We dropped back down towards the mean. Now this is a lagging indicator, so what we're looking at with these moving averages is history. But look again here where we broke out above the top, closed back down closer to the mean, and then just most recently, well, you can see this little spot here where we had the last few red days. We did sort of drop out of that. As a matter of fact, we have a little bit of an evening star pattern that held true for about a day, and then the market turned around and just ran with it. And we are outside of 2 standard deviations above the mean as we get into the close. Matter of fact, it is 4:06. The market has closed. Now that I take a look at this, when I was getting ready for the video, it was about 3:55, and time, I guess, got away from me a little bit. So looking at this, the market closed, and we're just barely outside of 2 standard deviations above the mean. So that's one reason why I think that the market might take a little bit of rest going into Friday. Also, people might lock in their gains prior to the weekend, so close out positions so they can go into the weekend with a healthy position, if you will. So let me get rid of the Bollinger Bands, and I want to put up the RSI, the relative strength indicator, and above 50. Right now it's sitting at 69.42. Above 50 means that we see bullish momentum taking place with the market, and you can see the bullish run that we've had. Above 70 can be an indicator that what we're looking at is something that is overbought and that a sell-off may happen. So we even have from the RSI, which we haven't broken 70. We're just close to it. With the Bollinger Bands up as high as it is, with as much green as we've had in the market recently, I wouldn't still be surprised if we still see a little bit of weakness coming up over the next few days, just in the short term on the SPY. So let me toss up QQQ, tracking the NASDAQ as it does, and check out that gap up. I'm just going to take a moment. I'm going to pause, and I want you to just appreciate the beauty of that candle. Bask in its glory. Take it all in. All right, let me zoom out from there so we can see where we're at. So if we go off the top of that candle, I'll toss up another horizontal line for you. There it is, horizontal line. And go down to the top of the candle. You can see that goes all the way back here. As a matter of fact, more recently, it's just off this peak that we have right here. So that could be a small sign of resistance for us. If you're one who's Fibonacci retracements or a Fibonacci extension, that's something that you could use to see if we also hit one of those Fibonacci values from where we're at right now. That could also be something to look for. Now, we have a fair amount of room to run for this. Up to this most recent peak that we have back here that we haven't broken yet. Let's zoom in. We'll find out where that high is, and we'll say it's between these two candles here. This one went just a little bit higher. This one peaked out at 333. Right now we're at 311, it's $22. That's 7% more room to run the NASDAQ. That's assuming we were able to break the current resistance that we find ourselves in. When we look at the RSI, which I left up on here, we're at 73.85, so we're above the 70 mark. So yes, we've had bullish action. We could be in overbought territory. We could see the bulls just take a little bit of a rest on this. Let me go back to my indicators. I'm going to drop the RSI. I'm going to get this horizontal line out of our way, and I'm going to put the Bollinger Bands on so that you can see, and I'll scroll through a little bit of this so you can see to the downside when we get unusually low values that it's not long after that we return back to more normal values and head towards the mean. So over here, get a big body, large body green candle where we dropped way outside of 2 standard deviations above the mean, and then that followed with a run there. So right now we get this really strong gapped up green candle, 2 standard deviations above the mean, and it is possible that we start to see a little bit of maybe sideways or maybe a little bit of drop in the market tomorrow. And honestly, like I said, leading into the weekend, it could be something that we can most definitely see coming up in the short term. All right. So that's what I have there. I want to talk now about Jerome Powell and what led to all this action. So for Jerome Powell, we got the 25 basis point hike. That was expected. And that little bit of certainty of it being just 25 basis points, I don't think that was our biggest sell. But I think that was just that little sigh of relief that kind of added a little bit of levity to the markets. That, all right, 25 basis points, that's cool. That's what we expected. Jerome Powell then said that inflation, even though it is subsiding, even though it's moderating, that it's getting closer to that 2% target. He did mention core services ex housing. And he said that we're not seeing the disinflationary pressures taking place there. And that actually sounds kind of like it would be bearish for the markets, except he went on to say, but it's in the pipeline. So that language, I think, makes it sound like the Fed already knows that their quantitative tightening measures are tight enough that they should start seeing lagging indicators really reflect in the markets. He is saying that it's in the pipeline. They believe the pressures are there, that the indicators just haven't happened yet. So should we see strong enough information coming out in February and in March prior to the next FOMC meeting, that could have a serious impact on their summary of economic projections that come out following their March meeting. So the Fed minutes that come out, I believe it's 3 weeks after their meetings. So we'll have to be on the lookout for that to see when the next Fed meeting minutes come out. That's going to be an important date for us to watch to see exactly what was said. So the other part that I think was very bullish for markets and why the markets rallied as much as they did was that Jerome Powell mentioned that they don't believe that GDP will go negative. They believe that there will still be growth. That means positive GDP, but it will be subdued. It will be much slower than what we've had historically. So we'll have to see what they come out and say for GDP moving forward. And we have to watch those measures for GDP to see how much is the economy slowing down. We have evidence to believe in December that things slowed down substantially. As a matter of fact, tapering from October, as early as October, seeing that inflation come down, seeing the economy slow down, and really watching the revisions for Q4 for GDP. When we get our second revision for Q4 GDP from the 2.9% that we're currently at right now, from the first release, from the advanced release, to the second estimate that we get for GDP, if that ticks downward, and if it ticks downward strongly, stronger than we expect, now down a little bit, I don't think is going to move the markets a lot. Down a lot and really pointing towards, heavy recessionary pressures coming into Q1 or signs of a deep recession in Q1, that could also be something that wouldn't treat the markets very well, because I think right now, recession, according to Jerome Powell's words, could either be being ignored or people could be listening to him. And what his words are is that we don't see negative GDP growth. We do see subdued growth or slowed growth. I know I'm paraphrasing here. I don't have the exact words in front of me. So that's something to really pay attention to, because I think that had a lot to do with moving the markets. And then another thing, and I think that this is really important, he addressed the tight labor market conditions. Labor markets are still tight. Inflation is still moderating anyway. So even though they are case for core services X housing, which could be a proxy for wages, and watching that to come down to help ensure that there isn't a wage price spiral is something very, very important to pay attention to. We do want that to come down. Back to the tight labor market though. So for the tight labor market, they are not seeing the initial jobless claims that they expected. They expected unemployment to go up, and unemployment is not going up. So they think that that could possibly spell longer term inflation, and they just want to wait and see as the reports come out, the economic reports come out over time, that inflation is moderating. And if it stays maximum employment, it sounds like Jerome's good with it, that the Fed is good with it. It sounds like what Jerome was most concerned about was taking the foot off the gas too soon, slowing things down too soon, and for inflation to come roaring back or to become entrenched, that we have higher inflation for longer. So the way that I conceptualize this as I heard him talking, if we think about high inflation, is inflation running hot, it sort of reminds me of firefighters when it comes to putting out a fire. So if you are a firefighter and you're watching this and I botched the analysis at all, please feel free to let me know down in the comments. And thank you, by the way, for all your bravery and what you do in putting out those fires. And I know that it's a daunting job. Let me move on from there. So inflation running hot could be that fire that needs to be put out, and the Fed is spraying water on it to put it out. And right now they see the flames dying down. It is almost out. There's a few areas that still look like hot spots. The fire is not tended properly and put out properly, that there could be spots that are still hot enough that they end up reigniting, and the firefighters, having stopped too soon, haven't really stopped the fire. I think that's what the Fed is worried about, is making sure that they keep water on the fire, that they keep it died down, that they cool down the embers, and that there's as little chance as possible for a wage price spiral or entrenched inflation, where we're dealing with higher inflation for longer periods of time, failing their dual mandate of price stability and maximum employment. So about those rate hikes, what can we expect from here? Well, when we look at the CME Fed Watch tool that we have, 475 to 500 basis points. So that's another 25 basis points in March. That's what's most expected in the next meeting. And if we fast forward from there and look at the meeting that follows after that, you can still see the most likely case. The target rate is still, the federal fund rate is still sitting at 475 to 500 basis points. So 4.75 to 5%. And if we move on from there, go even farther out to June, still staying the same, with some decent likelihood for it to be another quarter point after that yet. July, look at the highest peak, 50% chance that we still stay between 4.75 and 5. And then still, when we look at September, still the highest. And then when we get to November, this is kind of cool, but when we get to November, there's actually a rate cut that's currently expected in November when we look at the CME Watch tool. So about these rate hikes, what's going to influence them most? Well, Jerome Powell said it himself. Core services, X housing, they want to see that come down. It's not coming down, but they believe that it's in the pipeline. And I think that that is one statement that really, really stands out as to why we see the markets rallying the way that they do. So we'll have to watch the economic reports come out. The CPI, I'll put out my next release for that as we get near to the CPI, which I believe is Valentine's Day. What a lovely day for the CPI report to come out. And I hope that we love what we see from that. Also, I think that February 10th is the next time that we hear about consumer sentiment. If that ticks up, bull run on, baby. So consumer sentiment, which has a lot to do with inflation, also mentioned by Jerome in the meeting yesterday. So that's something to pay attention to. So if we get a strong read from that, if we get well above where we're at before, which is 64.9, and I think 65 is currently expected, if we go well higher than that and break maybe even a previous high beyond that, which we are at a local high point right now, that is something very bullish for markets. If we fall below that, that could be bearish for markets, especially if we see long-term inflation go up or even short-term inflation go up with either of those consumer sentiment surveys. So February 10th, watch out for it. Also February 14th, watch out for it. And then later on throughout the month, Fed minutes, I believe, will land for us 3 weeks after the date. So I don't have the exact date, but watch out for those Fed minutes, because the digesting exactly what they have in those minutes could really impact it. PCE also coming out is something that we really also want to watch. Keep watching the labor market, housing market. That's going to be very telling for us. And I'll have that stuff on my channel throughout the month of February. And all eyes are on March for that next summary of economic projections. That SEP, as it's called, when it comes out, I think is going to be absolutely mind-boggling for markets when it for the good or the bad. If it's worse than we expect, we're going to have a big old red day, especially if we've had a bull rally turn into a bull run and then, rain on our parade, just completely destroy it. Or if it's much better than we expect. I think if the Fed stabilizes and they say that they're done raising rates, oh my gosh, party on and, don the bull horns and start charging, because it's really going to be a good time in the markets for us. So that's what I have for you guys today. Thank you very much for listening. I really appreciate it. Check out the links down in the description. I got my Patreon link down there if you want to follow along with what I do. Also down there, you'll see the links for Moomoo and Webull. Click those links, deposit your money, and get your free stocks from those links that I have there for you. And the last thing, and most importantly, I really appreciate you being here. I'm Dr. Stock, Doctor of Education. We'll see you in the next video.